Good day. I am Emily French, and it is a very sincere pleasure to be virtually with you all for this year's World Soy Forum. Clearly, it is a transformative time in the world markets as we all continue to work through COVID. There will be a new normal, and at some point in time, likely when there is a vaccine or a prescribed course of treatment, we will all return to once again meet in person. I, for one, very much look forward to that day. So before I begin my talk, I want to extend thanks to everyone involved in the global agricultural circle of life. You all continue to nurture the world in a time where there remains plenty of uncertainties, fears, and concerns. We continue to be fed. We continue to introduce new technologies and solutions. Food products continue to move, and new markets are open, ever adaptable and ever changing. Perhaps it's because we deal with Mother Nature and weather nearly every day of our businesses, and so we know beyond reason there is only so much that is actually in our control. The U.S. Soybean Export Council, or as you know them as USEC, has been kind enough to invite me to speak as they continue to work very hard on their mission on behalf of the U.S. farmers and key stakeholders in a whatever, whenever, and wherever it takes fashion. There is little doubt that the world currently faces an extreme protein gap and a pending caloric crisis. And I'll address that towards the end of this presentation. So to that order, a quick preview of what's going to come up. I'll provide my macro hypothesis for the grains and oilseed markets, discuss the market structure and the risk of investment inflows, and that will be followed by a breakdown of each commodity: soybeans, soy meal, and soy oil. So this is my market thesis that I return to when I forecast prices, investment strategies, price risk management, structures, and so on. The bottom line remains: we are in a range-bound market. And there are numerous reasons for this, including the following bullet points. Demand uncertainty. Certainly under COVID, there are great concerns about the macro structure. How deep is the recession? Are we going to see modest growth in Asia, etc.? So demand uncertainty, and in fact, uncertainty may be the word for 2020. The strong US dollar, especially versus its competing exporters. In this case, Brazil on soybeans, Russia in wheat. So the currencies and that relationship will also be very key in 2020. A supply shock is needed. It's needed to change this whole range-bound market, and it's not a supply dislocation. We need a massive production loss in any country or major exporter to change this market dynamic. The idea that everyone wants to keep risk limited, that is very clear. This started with the China-US trade war, and maybe that war actually prepared many of us for COVID, because this environment where everybody wants to control what they can control and keep risk at bay is very much with us and has been with us. So as it relates to physical trade, much of this trade today remains back to back. So if you buy something from the farmer or an elevator, you are looking for the end user to offset that purchase with the sale. Price trade flows and influences, this trend continues to have a larger and larger influence, specifically from South America when it comes to the soy complex and corn, and then certainly the Black Sea as it relates to wheat, and in the case of Ukraine, corn. World importers. World importers have had the luxury of having the U.S. as the most transparent storage tank and market in the world. It holds more and more of the of the world's grains, and to a lesser extent, soybeans. So you always know where you can buy that next ton of grain or oil seeds, and that's from the U.S. Caloric deficit countries. Countries where the government subsidizes food prices, or countries where food security is very sensitive and needs to be controlled in order to keep the current power in power. This has shifted some countries from going from just-in-time buying to just-in-case, especially if the world sees wave 2 of COVID in that October-November timeframe of 2020. The last bullet point is kind of that implied price floor of Chicago futures versus the front month. And this is really where, I don't have any desire to be short these markets. And the market in general has shown it really doesn't want to be short at these price levels. So in summary, the bottom line here is that we are in a range-bound market as we finish the Northern Hemisphere planting cycle and work towards harvest of the various crops in the months ahead. This chart simply points out that while the sole fundamentals of grains and oilseeds can best be described as adequate and ample versus the demand scenario where there are plenty of concerns and headwinds, and overall a very bearish sentiment when it comes to commodities, we do need to acknowledge and look at the price relationship or ratio between commodities and equities. This relationship is at a record high level. So should the US dollar weaken, or if there is a rebalance from equities to commodities, that would put a bid or a new buyer under these markets. And as such, this would add a new dynamic risk to higher prices. Okay, so let's be aware of the macro structure and that relationship between equities and commodities. Following this idea of kind of what else is at play with our market structure, our range-bound market structure, let's look at the agricultural assets under management, estimated at about 102 billion US dollars. So where is that money? To the left, we look at that breakup where 37% of those funds are really pointed at farmland, and then 36% to private equity. And then the second graph is where is the money? What region has these investments? Over half of it, 53%, is found in North America, followed by 11% in South America. So again, another building block as to dynamics at work within our agricultural markets. So let's talk about the structure of the market. The structure of the market becomes much more important when, again, we're dealing with a range-bound market. This market becomes more susceptible or more influenced by money flowing in or flowing out. So range-bound market, the market structure and what the funds are doing in these markets does become more important. So right now, as of the 9th of June, the latest data point, the funds had a minor long in soybeans. They were flat, pretty neutral soy oil, but that net short position in meal continues to grow. They are selling more and more meal on a near weekly basis, with that position about 53,000 contracts. The risk here is that the record is 77,000 contracts. And anytime the funds are leaning this heavy in that direction, that market, soy meal in particular, is prone to a very vicious price reaction. And that will be to the upside. And as such, soybeans usually follow where meal goes. So again, that's more of a discussion of this market structure and what we're dealing with in this current environment. So let's get into the guts of it. This next, we're going to talk about global oilseed production. Soybeans completely dominate as the global protein source. It wears the crown of the queen or king, whatever your fancy is, and it is forecast to account for 68% of the world's oilseed production. Okay? So let's keep that in mind. the soybean is the largest. After production, we'll look at global oilseed consumption. Again, it is soybeans that dominate. Soybean consumption is forecast to account 73 to 74% of the world's oilseed consumption. Even more impressive, talking about oilseed consumption in general, is that in the period of 17 years, 17, the combination of soybeans and canola and sunflower consumption has doubled. And this is reflective of the very simple equation. Food demand growth equals population growth plus per capita income gains. So that equation of population growth plus per capita income, this slide highlights the ongoing expansion of global crush capacity. Okay? That is a positive. That is globalization. That is higher incomes. That is new technology being adapted in new countries. So since 2000, 20 years ago, seems like yesterday, crush has increased 113%, 113, or the equivalent of just over 166 million metric tons. Phenomenal growth. And that second chart to the right, the world crush by country that has all the colored lines, this shows where the crush is increasing. So China, the gray line, again, big population plus growing incomes. The others, that's the blue line, is starting to again increase as a percent of world crush, while the US, the yellow line, continues its decline, and South America, call it the red and green colors, that is largely holding flat due to the fact that Argentina, actually that's where a lot of the excess global crush capacity is found. So this dietary shift, this globalization, global growth is completely reflected in what is happening with global crush capacity. Let's look at another major trend. Another major trend that has occurred over the past decade is that the shift of more crush plants being built outside of the US or South America or even China. The chart on the left, the blue bars with the orange line, that looks at world soy meal export trade. It's been flat as more countries import soybeans and crush them for the products themselves rather than importing. This is a greater adverse or negative impact for really Argentina and to a lesser extent Brazil, as Argentina is the largest meal exporter in the world, followed by Brazil. But, however, what Brazil loses in meal export demand, potentially, it more than makes up on its own global growth in soybean export trade. So, meal trade is flattening, more countries want the soybeans, ergo, more competitors in the import or trade flows for world soybean trade. So let's move to the supply cushion. This is an attempt to take all these world balance sheets, supply, demand, numbers, countries. It becomes very convoluted and very complicated. So what I try to do is step back and say, okay, what do we really have? What are we really looking at? And I like talking about the global soy supply cushion, or really the supply cushion for any commodities. So to calculate that, you take global consumption, divide it by 365 days of the year, and you take that daily rate and divide that into the world's ending stocks. So on the 1st of September 2020, a few months from now, the world will have 104 days of use, just over 3 months. And then for the year ahead, 2021, so on the 1st of September 2021, the world will have 97 days. Obviously, a decline is expected yet again. So what that means is that the world is pulling down the stocks. They're consuming them, they're being used. And this trend shows that ongoing decline. The other thing we want to take a very close look at or remember is the world consumes nearly 1 million tons of soybeans every day. 1 million tons is consumed every day. So that means for every 1 million ton of demand loss or production gain, the world gains 1 day. And a 1 million ton of demand gain or production loss, the world loses 1 day. So as we move through the US crop cycle, crop is in the ground, it looks very, very good. For every gain of 1 million tons, the world will add 1 day to that supply cushion that is currently projected at 97 days. And I keep repeating 97 days because I want you to remember that because we're going to come back to it. So we got 97 days, just over 3 months. So let's look at world export trade. World export trade has been and continues to be driven by China. China has returned to a growth trend. That's positive. That's fantastic. We like growth. Growth is great. But the question is it the protein consumer demand growth, or is it a reflection of the government buying more reserves at decade low prices? Because that's literally what's happening. So one data point that supports concerns about consumer growth, or what's happening with the consumer in China, is that crush still runs below last year's level as the country recovers not just from COVID, but it's continuing to recover from the African swine fever. So those are two major demand hurdles that China will continue to have to work through. The chart to the right with the orange bars, that looks at China's own domestic supply cushion. And we target that because right now it's projected to be just over 3 months at 91 days. That will be a new high for this measurement. But even more important is that China holds 28% of the world's supply cushion. And the world will never see those soybeans again. It is not a major exporter of soybeans. So let's keep that in mind. Again, when we talk about that supply cushion, we'll come back to that. Obviously, as one discusses China, one has to discuss the China-US trade agreement. This graph looks at US soybean export trade and shows negative or contraction of growth, the red bars, and growth from the previous year in the blue chart. So positive, more volume. What this graph shows is, one, the sharp decline in 2018-19 due to the trade war, and those ongoing losses in 2019-2020. And the point two is that dramatic blue bar at the very top shows USDA's forecasted recovery of China buying US soybeans as part of its phase 1 commitments. So presently, the government forecasts US exports to be nearly 11 million tons. 11 million tons larger than this year. This will be a new record gain if realized. So the bottom line to the US export program and subsequently ending stocks will be, one, what does China buy in the weeks and months ahead? And secondly, and most important to world importers or anybody that deals in the global soy chain, it's going to be the US FOB capacity and logistics and its ability to execute much of the world's Q4 2020 and early Q1 2021 soybean import demand. The world will be very heavily reliant on the US given the record pace of soybeans that are being exported out of Brazil at the present time. Okay? So logistics matter, and what China does matters. So let's move back to the world supply cushion. Let's go to, and this is the take-home point. We're at 97 days. What becomes important, and this has been made glaringly obvious due to COVID, is where are the world's stocks, whether it's soybeans or corn or wheat or sugar or palm oil, so on and so forth. Where are these stocks? And there are a few trends in soybeans. China is storing more and more of the world's soybeans. The chart on the left, the blue bar and dark blue line, that is China, and the orange line is Argentina. So China's going to have 28%, and the world will never see these again, by and large. Argentina has 27%, and Argentina, as we all are very aware of, has ongoing issues. And that's not going to change anytime soon. Not even likely when there's another presidential election 3 years from now. So they've got lots of problems. Likewise, Argentina is not a major soybean exporter. Yes, they're number 3 in the world, but in total tonnage, it absolutely pales in comparison to its neighbor Brazil or the US. So for the world importers, or to gauge the value of one's own exports or imports, it is Brazil and the US. And this story is that looking at 2021, again starts the 1st of September on paper, the 2 largest soybean exporters in the world, will only store 37.5% of the world's stocks. This compares to 41% right now. So what does that mean? It means that the 97 days of supply cushion really is just 36 days. Just over a month. And this is for soybeans, the queen or king of oilseed production and consumption, and without a substitute, not on a one-for-one basis. And that same case goes for meal. So what we really are talking about is 36 days. Now, that is not to say that is bullish, but it is to say it will keep the market from breaking to new lows. The biggest change besides COVID in 2020 has been the Brazilian real US dollar relationship. We see that in this chart. It is traded as high as 5.9 to 1 versus a currency that was trading 4 to 1 real at the beginning of the year. At one point in time, the real US dollar had lost about 35% of its value. This is translated to record soybean prices for the Brazilian farmer. Likewise, there have been a lot more soybeans traded for Feb, March, April for forward export time frame than previously. The Brazilian farmer, we think, is probably about 40% sold for 2021 and pretty much sold out for this year. And this relationship, the currency relationship, is likely to be the most important relationship for the supply side of the world soybean equation. Okay. Keep an eye on open interest. As the top point reflects, it's up over 100,000 contracts versus this time last year. And that has been the Brazilian farmer selling. So currency matters. Currency is important. And it will remain very influential to Chicago soybean future prices, meal prices, than previous years. This is the U.S. soybean balance sheet from the June WASDE that was out just last week. There are 2 things to point out. One, the planted and harvest area will be higher. That's the top circled red part. Right now it's forecast at 83.5 million acres. I think it will be at least 2 million acres higher. And we'll get those numbers at the end of June, June 30th. So in reality, the U.S. is looking at a larger soybean crop rather than a smaller soybean crop. The other thing to point out, and we've previously discussed this, is that export demand forecast. It is forecast to increase nearly 11 million tons. And to achieve this, it absolutely is predicated, dependent on what China buys or does not buy. As such, the bottom line risk for U.S. ending stocks is that the current forecast of 395 million bushels, or 10.75 million metric tons, is to the upside, or higher stocks. And this is positive, because if the U.S. stocks are higher, that means we're adding to the supply cushion. Not all bad if you're an importing nation or on the import side of the equation. These charts highlight the U.S. soybean production as a percent of the world. So the very bottom line is that U.S. soybeans are a key sustainable supply solution for world soybean protein users. Period. Full stop. There is a growing likelihood that U.S. soy production could actually reach record levels for 2021. So the blue columns, that is USDA's current June forecast. Ultimately, that production could exceed 120 million tons and kind of return closer to maybe 35% of the world's production. Again, super positive, because the trend is more crush plants are being built overseas. Global prosperity, fantastic. We need soybeans, not meal and oil, because we want to crush them and produce them ourselves. To the right, the orange bars, that looks at soybean exports, and this is going to be impacted by two things. Barring any weather threat, which so far, again, it looks very, very good. But soybean exports will be impacted by China. And then what does Brazil produce in February of 2021 forward? They're forecast at 130 million metric tons. That would be a new crop. So we'll keep an eye on that. But I always remember this: if there's any weather threat in Brazil, I always have to remind myself that at the end of the day, Brazil is a rainforest, and they will have a crop. So keep that in mind. Let's talk about how the U.S. utilizes its soybean production. Because exports, and this is why USEC puts so much effort into exports, I mean, that is their mission. Because exports are the future growth engine for U.S. soybeans. So right now, that export as a percent of production, the blue vertical lines or columns, it has gone from 30%, exports were 30% of its production in 05-06, so 15 years ago, to nearly 50%, 50, for the new marketing year. So half of U.S. production is going to feed the world in one form or another. And then the chart to the right, the orange bars and the blue line, the orange bars are probably what is most important. It shows more or less a pretty flat to stagnant growth for crush numbers and capacities coming out of the U.S. You aren't hearing of new crush plants being built in the U.S. Maybe expansion of existing capacity. Just like you don't really hear many crush plants being built in Brazil or Argentina. Yes to Pakistan, yes to Bangladesh, yes to India, those sort of things. Soybean exports are the growth engine for the U.S. utilizing its soybean production. It's feeding the world. Let's take everything that we've taken and listened to. This is the weekly soybean price. This chart shows where prices are relative to 2015. You could look at the monthly soybean chart, and it's still very similar in that we're really kind of bottoming here. That 825 versus the front month future seems to be holding as the low. And the low of soybeans actually was at the height of the U.S.-China trade war. It briefly broke below $8, but did not stay there. And that was when ending stocks were forecast at 909 million bushels. Again, right now they're forecast at 395. So a dramatic difference. However, we are and continue to trade the ranges. And right now we're kind of in the mid-range of that price cycle. So let's call the upper end, the extreme upper end, barring any production threat. The extreme upper end for soybean futures is 950. I think they continue to hold that 920 to 915. And then the bottom side or downside would be 825, 830. Okay? So again, range-bound market. That's your range. So let's look at soy meal now. We've talked about soybeans. Let's talk about meal. And we're talking about meal because that's where that fund short is parked. And it remains a very susceptible part of the market makeup to a movement to the upside. So we're going to use the same exercise as we did in soybeans, and we're going to look at the soy meal supply cushion. Those are the blue vertical bars. And obviously, it's on a decline. And it's been declining from the peak of 2014-15 every single year. And in fact, 2020-21, the supply cushion is just going to be about 15 days. That's it. That is it. That is barely better than the 12.6 days, the record low of 2008, 2009. So supply cushion declining, supplies are shrinking, an awareness there. The funds are big short. Argentina, the world's largest meal exporter, has 0 to negative crush margins. Brazil, negative crush margins. It's the world's second largest meal exporter. On the demand side, that is the graph to the right, the orange vertical lines, we remain very wary of African swine fever and COVID and all those challenges. But there is a feeling more and more that, okay, we are recovering, we're stabilizing, we're getting through this, and in fact, we might really be building. So if we're starting to build, and if the supply cushion continues to drop, and if crush margins remain under pressure, there is a likelihood that we could see meal prices trade towards the upper end of the range. So to that point, the next slide shows this weekly soy meal price. And again, going back to 2015, and you can pull up the monthly charts as well, we are consolidating and we're bottoming, and it's been impressive. It's been impressive. It's been able to bottom in the light of African swine fever, which is demand destruction, in the light of COVID, which is demand destruction, and so on. So let's call the lower end of the range in meal, the price range, call it 280 to 285 versus the front month. I do think that the futures continue to build in a carry. We have to remain very sensitive to what's happening in Argentina and Brazil. But again, the meal market is stable. It is carving out a bottom. So that would suggest there is limited downside price risk to the entire complex, and limited risk that the entire complex breaks out of that lower end of the trade range. Okay? Upper end would probably be that 300. So 280, 285 to the downside, 300 to the upside. Okay, we're going to move on to soy oil, the third leg of the complex. Next slide. And it's the supply cushion. Once again, it makes yet another appearance. And really what you can say about the soy oil supply cushion is that it's quite stable and has been stabilizing. Largely flat over the past 4 to 5 years. And there's few changes expected for 2021. A decent demand growth engine for soy oil has been, over the past decade, has been biodiesel. And this obviously, whether it was biodiesel or ethanol or energy in general, took a massive hit on the back of COVID. And I don't think we're out of the woods yet. The US continues to report cases. Brazil continues to report cases. Europe reports cases. Russia, China, it's not going away. And the risk of wave 2 is still there. So to that point, while I think most of the bad news has been absorbed in soy oil and really in palm oil, we're not out of the woods yet. We're not out of the woods yet. Because if you look at the second graph, the horizontal orange lines, that shows the industrial use of soy oil, most of that being biodiesel. And as you can see, you don't even need the numbers. As you can see, dramatic growth over the 2 decades. And that is now set for contraction. So if one of your major growth engines is now set to contract, that's not positive demand signs that you probably want to be seeing. Now, stepping completely back, let's realize that soy oil follows palm oil, and it's palm oil that absolutely dominates the global veg oils and really sets the tone of trade flows and demand. This slide shows the domination of Argentina. It's the world's largest soy oil exporter. It's forecast to account for 51.5%, 51.5% of world trade. Again, the key there is that Argentina has negative crush margins, or trending towards negative crush margins. And Argentina has a lot of problems. So we need to keep an eye on that. Conversely, if you get over to the next chart, the orange vertical bars and the red line, that's U.S. soy oil ending stocks. And the U.S. is the 3rd largest soy oil exporter in the world. And what you like to see as a world importer or a veg oil importer is that ending stocks are pretty stable, and they're holding 21.5% of the world stocks. So soy oil to me looks very, very stable, all things considered. It's recovered, but I think it's going to just kind of teeter towards that lower end of the trade range because, again, the decimation or the hit from the biodiesel side or the energy side of the equation. This relationship here I think is super important because soy oil for the entire complex, it's very anticipatory in nature. So it trades what might happen well ahead of when it is happening. And unlike soybeans or meal that typically react when something actually is happening. Okay, so soy oil is very anticipatory in nature. It is a leading technical indicator for the soy complex. So if the oil market starts breaking out of the major moving averages, it is likely that soybeans and meal will follow in that trend. And the third point, which I think is very interesting, and the CME chart it shows this relationship, is that the relationship of crude or WTI is that soy oil is a leading indicator for energy. So again, we're all in the energy market. We all use crude oil in one form or another. So that's another reason to kind of keep an eye on what soy oil prices are doing or not doing. Like we did with soybeans and meal, this is a look at soy oil. We see the plummeting of soy oil prices since the start of 2020. And now just kind of a modest recovery. We're still down 21% on the year. So we're not back to whole. But the question is, are we stabilizing here? Is all the bad news kind of baked in? And it seems like yes. The answer is yes. So let's call the downside, 26 cents, front end month soy oil futures. And probably the upside is about 30 cents. And you see that 30 cents largely holding as either peaks or bottoms over the past 5 years. So this is the third to the last slide. We're almost home, but we're going to use USDA numbers and look at Russia quickly on its meal and soybean consumption. And like many countries in the past decade, global prosperity has led to higher protein consumption and, with that hope, improved diets. All of Russia's domestic soy meal consumption is now met with domestic production, with only a limited soy meal imports. This is reflected in the chart on the left. In the chart to the right, this reflects the growing soybean production for Russia. And this is feeding its crush facilities, while soybean import demand has been largely flat or stagnant. That would be the blue vertical columns on the chart to the right, really quite flat over the past 5 years. And so for 2021, Russia's bean imports are forecast at 2 million tons. So let's bring all of this home. And that's this. the protein gap. The message is U.S. soy is the world's sustainable protein solution. This protein gap exists, and it's very real. The two charts in this slide are part of Mizzou's Asia Outlook. So hat tip to them for these two wonderful pictorial graphs that show the protein gap in Asia. We're not talking about Africa. This is Asia. And in 2018, that protein gap was at 135 million tons and growing. Slower growth, but growing nonetheless. And then the Asia protein gap, let the picture speak for itself, chart to the right, is you look at the global oilseed trade and where it's headed. And then you look at the global meat trade and where it's headed and where it's expanded. So there is no more real story in agriculture than that of the past decade's global prosperity and changing diet landscape. But what is as real is the story of the growing caloric gap, or what we would also call that protein gap. By 2023, 3 years from now, China, India, and Africa will make up over half of the world's population. Half, 50%. And we all know how fast time flies, especially as we get older. The protein gap exists where one, big population and growing populations lie. Two, where per capita consumption is on the rise, and perhaps most importantly, number three, there is limited arable land for production. So what does that mean? Simply put, these countries and regions will be heavily dependent on imported raw materials in the forthcoming years upon years upon years. So as a parting message, let me state unequivocally, U.S. soy feeds the global protein gap. Fuel for now, fuel for the future. But as I note in Fact 1, there is no single solution to fill the protein gap. There lies an abundance of opportunity for the persons listening to this talk, participating in these markets. The second fact is that Asia and Africa account for the majority of this gap. That's no surprise. We've seen that trend occurring. Fact 3, regardless if it expands or contracts, it exists, and it will exist through my lifetime and generations beyond. And fact 4, specific to soybeans, global crush capacity will continue to expand in growth markets, not mature markets. So we all play a part of the answers for this question. The question being, how is this gap filled? This is the biggest challenge and question that really faces the world. How do we feed the world? We've been dealing with this for, some would argue, far too long, especially for those that still don't have enough to eat. But some of that answer of how the gap filled, it will be a mixture of meat, plant, and the quickly evolving food alternative protein market. And where there are larger gaps, there is a greater willingness to look at all protein, and in all of this transition, sustainability becomes much, much, much more important. So in closing, thank you for your time. I wish you all the very best in the weeks and months ahead. Keep safe and healthy. Work to fill that protein gap. Everyone is needed. Stay positive and keep well. And is there anything that we can be of assistance with? Don't hesitate in asking. It doesn't cost you anything. Take good care and best of luck.